Hey everyone, welcome back to the channel. Today we're diving into several major headlines and investing news impacting the auto industry and the tech sector from this week. In this video, we'll go over President Trump's announcement of a 25% tariff on imported cars and car parts, developments from Chinese electric vehicle giant BYD, and break down what this means for Tesla. We'll also cover the latest update on further demand for Nvidia's chips, on indications that Apple is gearing up to invest over $1 billion in generative AI services. Before we dive into the main topics, we'll do a quick update on my portfolio. Over the past month or so, the market has dropped around 10% from its all-time highs. The market rebounded a little in the last 2 weeks, but has since dropped back down to near all-time lows for the year. We'll have to see whether this is only the start of a larger decline and whether additional trade tariffs will cause a further market sell-off. One stock I've been buying more of is Google. Its price fell from a high of $207 to around $154, a decline of around 35%. As you may have seen in my previous videos, I increased my investment in Google by around $9,000 over the past month or two. If the price continues to drop, I plan to add more to my position, provided I don't find better value in other companies in the market. I've also increased my investment in Meta in the last week or so. Meta's stock has declined by around 22%, dropping from an all-time high of $736 to roughly $576. So I've added over $4,000 to my Meta position. I'm seeing strong double-digit growth of above 20% annually in their core advertising segment, and I'm also optimistic about their smart glasses initiative over the next 5 to 10 years. Meta currently ranks as the third largest holding in my portfolio behind Fortinet, though it is steadily catching up. If there's any further weakness in Meta's stock price, I may increase my investment in Meta, and Meta stock may end up taking the position as my second largest holding from Fortinet. Overall, my portfolio has declined by around $15,000 in the downturn over the last 3 months. I view this as a short-term price movement and don't see this significantly affecting my assessment of the underlying fundamentals of the businesses I own. In fact, I think that the price drops present a more attractive opportunity to allocate additional capital into these companies compared to just a month or two ago. Now let's start with the major tariff news. President Trump has announced a 25% tariff on imported cars and car parts, a measure aimed at revitalizing domestic manufacturing, but one that is expected to disrupt the global auto supply chain. These tariffs raise critical questions about their impact on automakers' supply chains, as well as the broader effects on demand, revenue, and profitability. The auto industry relies heavily on a complex, globally integrated supply network. Even US-based auto manufacturers like Ford, General Motors, and Tesla, which assemble vehicles domestically, depend on imported components. On average, nearly half of the vehicles sold in the US are imported, and those assembled domestically often incorporate a large percentage of foreign parts. I anticipate the newly imposed tariffs will increase production costs across the board, affecting both traditional automakers such as Ford, General Motors, and Stellantis, as well as new entrants like Rivian. These companies now face heightened expenses and potentially supply chain disruptions, challenging their operational stability. In the short term, the increased production costs are likely to translate into higher vehicle prices for consumers, particularly for imported vehicles. Analysts project that the average price for a car could rise by up to $4,000, while more expensive cars or electric vehicles might experience price increases of over $10,000. Although the long-term objective is to stimulate domestic production and grow jobs in the US, the short-term effect may be a decline in sales volumes and a contraction of the market as customers react to elevated prices. Automakers operate on relatively thin profit margins while simultaneously having significant capital expenditure. The imposition of these tariffs introduces additional financial strain and will likely compress profits in the short term. Companies must now decide whether to absorb these increased costs, pass them on to consumers, or invest in restructuring their supply chains, a process that is both time-consuming and costly. This environment of uncertainty may further dampen investor confidence and impact stock valuations. The overarching goal of these tariffs is to reconstruct domestic supply chains, reinforce US manufacturing capabilities, increase jobs in the US, and increase local demand for US vehicles. Global automakers have long optimized their operations around internationally integrated supply networks. Transitioning to a more domestically focused production model entails significant expenses and is a process that could take several years. During this transition, companies are likely to encounter immediate supply chain disruptions, contributing to the increased volatility in the market, characterized by higher consumer prices and reduced sales volumes. The announcement of these tariffs has already caused the decline in the stock prices of major auto companies. Manufacturers such as Ford, General Motors, and Stellantis, and international firms like Toyota have already experienced notable decreases in their market valuations. This downturn reflects investor apprehension regarding the potential financial impact of these tariffs and the broader uncertainty they introduce into the industry. Focusing on a company like Tesla, its stock has declined around 40% from its all-time highs, a drop influenced by multiple factors beyond tariffs. In my opinion, a significant portion of Tesla's valuation is based on advancements in full self-driving and the potential for future robotaxi services. These areas are primarily driven by software development and innovation rather than the cost of auto parts, meaning that recent tariffs should have little direct impact on these developments. For investors whose investment thesis centers on Tesla implementing full self-driving and robotaxis, the recent decline in Tesla's share price may represent a more attractive entry point. Next, I want to share my thoughts on a major innovation in the electric vehicle charging space. Chinese EV leader and Warren Buffett-backed BYD has recently announced an ultra-fast 1 megawatt charging system that can reportedly charge a vehicle with a 250-mile or 400-kilometer range in just 5 minutes. This breakthrough, which is said to be twice as fast as Tesla's current charging technology, could significantly reduce charging times and help mitigate range anxiety for EV owners. In my view, this development is not a threat to Tesla in the long run, rather it could have a positive impact on the overall EV market. While BYD may currently lead in charging speed, I expect we'll likely see a similar innovation come out of Tesla in order to remain competitive. When developed, rolling out this enhanced charging capability to Tesla's Supercharger network should help accelerate the adoption of EVs globally. Adding to the rivalry between BYD and Tesla, BYD's recent earnings results indicate that the company has achieved annual sales surpassing $100 billion, which is a 29% increase in revenue over the previous period. BYD's revenue now surpasses Tesla's roughly $98 billion in annual revenue. BYD's focus on more affordable SUV vehicles increases competitive pressure in the EV market, and I believe we could see Tesla consider further price reductions to boost sales volumes. Considering the new tariffs, on the other hand, there is a potential that Tesla's market share in the US could partially be protected by making Chinese manufactured vehicles relatively more expensive. In my opinion, Tesla's long-term competitiveness will depend on its ability to continue innovating, maintain an integrated supply chain, and expand its production capacity to meet growing demand while remaining cost-effective. And finally, in Tesla news, the company recently had an all-hands meeting, and at this presentation, Elon Musk gave some investing advice. So let's have a listen.
What advice would you give a young person getting into the stock market?
Stock advice. Wow.
Yes, sir. Yes, sir.
As I think people can perhaps tell who are watching this, these questions are not prepared in advance. This is literally random questions from the crowd, which is cool. I'm fine with that. And I think that it's going to sound very straightforward, but you want to really buy stock in companies where you think the products that company makes will be better in the future. Is that company going to make more and better products, or do you love the products that company makes, and are they going to keep doing that? And I think Tesla, as I've just gone through, Tesla has a track record of having made many great products, and we're going to make many more future great products, and we're going to scale up production, and I think we've demonstrated a level of innovation that is extremely rare. Certainly by far the most innovative company in the car industry, not even close, type of thing. I do think Tesla stock actually long term, with Optimus and self-driving, Tesla will probably be the most valuable company in the world. But there are also other companies out there that make great products and services. So I think that's the way you want to look at it. Say, do you think this product, because that's the reason why companies exist, is to make great products and services. So if you think that a company is going to improve over time, then buy the stock, and if you don't, then don't. And then the stock market it's a very strange thing. It's kind of like, I think it's Warren Buffett's sort of metaphor or analogy is, the stock market's like having someone stand at the edge of your property or your house and yell prices to buy or sell your house every day. And sometimes they take their meds and sometimes they don't. So sometimes the person yelling out the price of your house is having a good day, and sometimes they're having a bad day. But it's still the same house. It's literally still the same house. So Tesla stock goes up and it goes down, but it's still the same company. It's just people's perception of the future. I don't know. I guess it's just very emotional, So, but for me, while it's difficult to predict how things will be from, in the next, say, 6 to 12 months, if you say where will things be in 3 years or 5 years, the future of Tesla is incredibly bright.
No, I mostly agree with this. I think you want to invest in companies that sell products that customers get meaningful value from. And there will be cases where the price of a stock will deviate from the intrinsic value of the underlying company. To add to this, I focus on companies that, in my opinion, show strong growth potential and either demonstrate or show the potential to demonstrate strong returns on capital. Now let's turn our attention to a new development in the tech sector. Recent reports from Loop Capital suggest Apple is planning a substantial investment of around $1 billion in Nvidia servers. The stated purpose of this investment is to enhance Apple's generative AI capabilities. It's important to note that we don't have an official report from Apple to verify these claims, as far as I can tell. Now, historically, Apple has favored its own silicon and to some extent Google chips for its AI infrastructure. This approach has, in effect, minimized Apple's reliance on Nvidia, the clear leader in AI GPUs. While Apple hasn't explicitly ruled out using Nvidia, its disclosures about its AI hardware and software have notably omitted any mention of Nvidia. In my view, Apple's progress on its Apple Intelligence initiatives has been slower than many anticipated. To truly capitalize on the growing demand for AI-powered devices and remain competitive in a market where generative AI is increasingly becoming a differentiator, Apple needs to aggressively revamp its AI strategy. This involves significant infrastructure investment. While $1 billion is a considerable sum, it's crucial to consider this in context. Nvidia's latest annual report reveals that its compute and networking segment generated a massive $116 billion in revenue. Furthermore, Nvidia's financial statements indicate that 3 major clients account for over 30% of their total revenue, approximately $40 billion. This highlights that this investment by Apple is not a primary revenue driver for Nvidia. When we look at the broader demand for Nvidia chips, the capital expenditure plans by other tech giants are staggering. Meta, Google, Amazon, and Microsoft are projected to collectively invest around $280 billion in AI data centers in 2025. This represents a roughly 30% increase from the $220 billion they invested in 2024. Compared to these colossal figures, Apple's potential $1 billion investment in Nvidia's hardware appears relatively modest. This suggests to me that Apple may be pursuing a strategy where Nvidia chips complement existing custom Apple silicon chips. Though regardless of the specific approach, I think this potential move signals recognition by Apple that having dedicated, robust AI infrastructure is essential for long-term competitiveness. It's also vital for potentially reducing dependence on third-party cloud providers for core AI functionalities. I think increased demand from Apple, if realized, would be a positive catalyst for Nvidia stock, not just in the short term, but potentially in the long term with recurring demand for chips. I think there's also broader implications across the semiconductor industry, as increased demand for chips and data centers will likely increase demand for products and services from the likes of TSMC, ASML, Broadcom, and other companies in the space. That's it for the updates in this video. Let me know in the comments section below what your thoughts are on these tariffs, the electrical vehicle charging innovations from BYD, the impact on Tesla, and the potential demand for Nvidia chips from Apple. If you found this video helpful, hit that like button and subscribe for more stock investing news and insights. Thanks for watching. I'll see you in the next video.